You're listening to the greatest multifamily investment advice show. My name is Adam Ras, and now I'm talking everything multifamily for an in-depth conversation, and I will be diving deep into raising capital, deals, and underwriting process. Welcome back to the greatest multifamily advice show. Today we have Jose Jafferji, Canadian real estate investor with a significant portfolio in the United States. Help me to welcome the principal of the Seve Real Estate Group.
Yeah, thanks, Adam, for having me.
Thanks so much for being with us today, and I appreciate you taking the time. So I would like to start with the beginnings as a multifamily investor. What was the beginning for you?
Yeah, so just like a lot of other investors, I started way back in 2007, bought my first property, single family home. I was trying to do a flip, and right here, not too far from me in Brampton, we found a power of sale property at the time in '07. And I thought I was watching a lot of reality TV shows like Flip This House. So I thought why not do the same thing and make some money at it. So that's what I did. I took action, but I had no knowledge or no investing experience at all. I just took a loan from my dad, and I was working working as an engineer, so I could qualify and get a loan at the time. So I did manage to buy that property, fix it up, and when I was trying to sell it, the market had kind of gone down a little bit. So, and I over improved, and of course I didn't know the number, so I ended up losing around $7,000 on that first deal.
So
that
this
was
is
a
always
hard
the power of
lesson.
sell.
Yeah.
Okay.
And then later on, I started buying in other markets. Actually, I started off in Windsor, Ontario. At the time, I didn't have a lot of money, so chose the most I guess cheapest market in Ontario at the time. I had a
Correct.
lot of deals available even on MLS. So I went in and just bought aggressively number of properties. Some I did some flips on, some we did buy and hold. We bought some fourplexes, triplexes, and dealt with a lot of challenges. And then moved on, educated myself a little bit further, and then started buying in better areas.
So you started
And
on Windsor back to 2010, 12, or recently?
yeah, Windsor was around 2010. Yeah.
Okay.
2010, yeah.
Back then, I think the price was like 70 and 80 per door. And
Yeah.
not per door,
Oh,
by single family.
yeah, exactly. So I bought stuff for even cheaper than that, like 60,000 for
Wow.
a single family home.
Okay.
I actually bought for 80,000 a triplex,
Okay.
and that was my first deal. Was actually kind of a life changing, because I immediately I dealt with some bad tenants, and I rehabbed the property. Spent around 16,000 to renovate, and then I within like 4 months I refinanced the property, and I got a check from my lawyer of around 50,000.
Okay.
And that was officially the burst strategy.
Yes.
That's when I'm like, I knew I was onto something, that this is what I want to do. Um, and then I actually started investing in US as well. We bought a number of duplexes. And then, as time evolved, I educated myself and got into better markets like Hamilton. Our portfolio right now is primarily in Hamilton, in the East End in Oshawa, as well as Kitchener, Cambridge, Brantford.
Okay.
Yeah.
So you have a heavily focus on South Ontario and also US.
Correct. Yeah, we have around 150 units in Ontario, and we primarily buy now 20 to 30 unit buildings. We used to buy 20 to 30 unit buildings in Ontario.
A
but
year, you mean?
yeah,
Okay.
yeah, per multifamily property.
Yeah.
And then when things got so competitive and tight and the numbers didn't make sense, we started exploring in the US market.
Hmm.
A-
So
and yeah.
what was the upside for you? Because you opened the subject of Ontario and US. So what was the main points apart from, I think the price wise, Berdor was a game changer between US and Ontario. Also, the cap rate is another issue. But for you, what was the upside of US versus Ontario?
Yeah, the biggest thing is that you know, it was getting very difficult to make the numbers work.
Hmm.
Especially if you know, we primarily, our strategy was in Ontario was we didn't really, we work with a lot of hard money. We didn't do any kind of equity raises,
Okay.
because from my point of view, it didn't make sense to have equity raises when you cannot do a pro forma based on executing a business plan,
Hmm.
because you don't know when you're going to get that tenant turnover, how
Yeah.
much you're going to, when you know, when you're going to be able to raise the rents. So hard for anyone to do a projection on a pro forma to present to investors, because your plan could go one way or the other way, right?
Because I think you're mentioning to a main subject, which is rent control on South Ontario, because you
That's right.
cannot have evicted unit until uh, you have the unit empty already.
Yeah, exactly. So it is not as landlord friendly,
Yeah.
right? And whereas in the US, in southeast US,
Yeah.
like I primarily focus in on state of Georgia, Texas, and Florida.
The red states.
Yeah.
Yeah.
And those are landlord friendly.
Yeah.
They have no rent control,
Yeah.
and provide really good cash flow too.
Okay.
So
Yeah.
it becomes easier for you to raise money when you have a great deal that you can present to your investors,
100%.
and you have a, you know, at least a plan to implement your business um, opportunity, because you know that you're going to get a certain number of turnover,
Hmm.
and you're going to raise the rents a certain way, um, you know, whereas things are a little bit more, at least you can put it in your pro forma what your rents are going to be after, how many vacancies you can incorporate, um, to, you know, how much increase in net operating income you can actually
Hmm.
get to, right? Whereas over here, you're kind of relying on natural turnover. Perhaps you know, you got to work out a deal with the existing tenant, but there's really, you're there's not really a proper way to implement that, right? It's not predictable, because from my personal experience, you know, we own several buildings, and some buildings work out much better than others.
Hmm.
Some we're just, nobody wants to move, right? So we can't get that turnover that we were originally looking for.
So you're referring to cash for keys.
Correct. Yeah.
Yeah, okay. So I'm gonna ask you a direct question here about the actual evolution for you to change to US market. So if we're comparing apple to apple, performance wise, so if what is your previous um, internal rate of return between Ontario before and your target market now in US in Atlanta? So when you're comparing, what is the upside number wise?
Yeah. Great question. So when I'm analyzing underwriting a deal in the US, I'm looking for a couple different metrics. So number one is cash on cash return.
Yes.
You know, we target at least 7% or higher cash on cash return.
Yes.
Um,
Which is here 5%. In Ontario, maximum what you can get here, cash on cash return is about 5%.
Oh, not even,
Yeah.
not even. Well, initially when you're buying a property, you're going to be negative cash flow.
Yes. The cap rate right now is about 3, 2.5 in some places. Then you're gonna have, yes, negative cash flow, correct.
Yeah. So with the properties that we're buying, we're cash flowing on day one.
Yeah.
7 to 8%.
Yeah.
Some deals that we recently closed on, it was over 10%.
Hmm.
However, now with the interest rate hikes, cash on cash has dropped a little bit.
Yeah.
Um, and the second thing we look at is the total return. Our
Hmm.
goal is to double the investor's money in 5 to 6 years.
So equity multiplier is equal to
Two,
on
correct,
a pro forma for 5 years.
correct, yeah.
Okay.
And then other thing we look at is IRR. We want it to be at least 15% to 18% IRR.
Okay. Good. And cap rate?
Cap rate, the ones we're buying currently are around 4.25.
Even in US?
Yeah.
Okay. There's no
Going in
budget.
cap rate when we purchase, yes.
Oh, okay. And
And then when we do a conservative underwriting on our exit cap is usually, on this specific deal would be close to 5.
okay. So also your target also is, I think this is another lesson for listeners, is your opportunities have to have like a potential, which is basically the ratio between the current expenses to the NOI. So usually if it's above 50%, 60%, you're going to see potential that you can enhance the performance to have a better NOI. I think this is another upside, I think, about US or your model anyway, because you're looking to enhance the management, enhance the expenses to have a better NOI and raise the actual income of the
Yeah,
building.
100%. And that's a great point that you brought up, because in the US, there's also a lot of opportunities to increase income by charging for additional things. We call it ancillary income.
Yeah.
So, for example, we can provide washer and dryer for additional $25 fee or $50 fee.
Yeah.
We can provide, there's a trash fee, there's a pet fee, there's an application
Yeah.
fee.
Yeah.
There's so many things that you can charge depending on the property and the profile and the demographic. Uh, Essentially, whatever you can charge, and your tenants are okay with it, you can go ahead and do it, right? So it's unlike here where you're capped at, okay, you can only charge rent and maybe parking and laundry, right?
Yeah.
So there's a lot of other income opportunities that you can add on as well.
So
And
your strategy based on which asset class, neighborhood wise and building wise? You're looking for B buildings or C buildings? So
yeah, we primarily focus on class C and also some B as well,
neighborhood wise or building wise?
building
So
wise.
and class
Neighborhood,
C.
we're working on our second deal, which is in a much better neighborhood
Hmm.
in contrast to the last one.
Hmm.
We want it to be a neighborhood, obviously, which is kind of an emerging neighborhood, rapidly growing, low crime rate. So those are the most important things. And of course, it's close to transportation hubs and employment hubs. And I'm primarily targeting larger cities in the U.S. So, for example, Atlanta, Dallas, and Jacksonville, Florida. So these are all large metro areas.
I
You're
have a
always
question
gonna
about
have,
this.
yeah.
Do you think it's more more challenges on the big cities like this because you're looking for appreciated market beside an actual cash flow? I think the challenge is more than like when you're looking to Alabama, for example, when the price per door is less. Of course, the appreciation is going to be less, but the competition at the same time less. So how you manage to have this balance of because I'm not going to say you're a newbie, but for the US market to work on a big deals on multifamily, you're new to the market. How you manage to figure this out to manage this balance? Because you have to offer something better than the other investor on this competitive market.
Yeah, no, that's a good question. So it's all about building relationships,
Hmm.
right? And so we have a strong relationship with the broker in
Okay.
that area, and the same broker brought us the second deal, you
Okay.
know, because we have a track record of closing,
Hmm.
and we leverage that to get our next deal.
Okay.
And so the second deal was actually, we got the opportunity to do an early access agreement and almost preempt the deal,
Hmm.
the offer. So we weren't in like multiple competition,
Hmm.
you know. And so yeah, it's all about building relationships. And the reason we chose these larger metro areas is because we're raising money from Canadians as well, right? So
Yeah.
and if they haven't heard of a city, they're likely not going to invest, right? So
Okay. Good point.
so that it just makes it a lot easier because they're at least familiar with the city, and has large employers and headquarters. For example, in Atlanta,
Makes sense.
we've got
Hmm.
headquarters, Coca-Cola headquarters, CNN,
Yeah. Yeah.
UPS, FedEx. All these large companies that they've heard of are located in Atlanta.
And there's established development already planning there with main highways, and as you mentioned, it's a big community.
Yeah, it's a large multifamily market as well. So
Yeah.
we're targeting, I would say any market that is $50 billion or more.
Hmm.
Give you an example. Dallas is $140 billion market.
Hmm.
Atlanta and tech and Houston is another 100 billion each.
Yeah.
And GTA, all of GTA is around 100 billion
Yeah. Yeah. Yeah.
as well.
Yeah. I think the price per door there is more than I don't know about Atlanta, but the price per door is more than 180 now there.
Atlanta,
Yeah.
yeah, pricing, it really depends on where you're located.
Okay.
So if it's a Class C building in I would say, a C area, then you're gonna get a much lower price point.
Yeah.
Um, that area may have a little bit more crime,
More challenges, of course.
more challenges to deal with, but you're gonna get it, let's say, close to 100,000 a unit, right?
Yeah.
Whereas in a nicer suburb of Atlanta, you're gonna be buying at 140 to 160 a unit.
Yeah. Yeah.
Sometimes more. It depends on the quality of the property,
Yeah.
and it's not just based on the price per unit, but also the net income.
Yeah. I think my next question would be a general question about the transition itself, because your model is based on you live in Mississauga, but you're running a business in US, which come to this how you manage to work with your long distance business model to create your core team, including, as you mentioned, it's about trust relationship with your core team, which is commercial realtors, property managers, because this is both main anchors to succeed, to be honest, when you're approaching the long distance management style. So how you started this relationship, one side, the second part also the lending side, because me personally, one of the challenges with me was boot on the ground, that you have to have an actual um, at least investment on single family style before you start jumping. But not all of the lenders, of course, but this is one of the challenges for the Canadians to work on the US side on the multifamily. So what was your experience and your steps to manage to succeed on this long distance management style?
Yeah, and it's you don't try to do it everything on your own, right?
Okay.
You partner with people that you can leverage your experience. So, for
Mm,
example, property manager, we're dealing with an excellent property manager in the local market.
mm,
They manage over 10,000 units.
mm,
They have systems and processes in place. Um, and the other reason we're targeting like usually 100 units or more
Mm.
is because they, there's for example, two staff on site, two leasing staff on site, and then two maintenance staff on site. So there's it becomes a lot more efficient to manage these properties because there is always somebody on site to do the leasing or the maintenance items, and then everything else is kind of subcontracted out. But yeah, you rely on a team that's going to help you to get to where you want to do, right? There's a lot of people that you can partner with. For example, us, we also partner with other capital raisers, and then because we found the deal, we did all the underwriting, we present a deal to other potential partners, and they may want to become a part of our team.
So is it going to be co-GPs or is it going to
Correct.
be?
Yes.
Yeah, co-GPs. Okay.
Yeah.
Yeah. I like this approach. But again, you didn't tell me about how you managed to start the actual relationship, how long it take you to, because potentially you're going to have multiple interviews until you found your preferred property manager. But in your case, it's going to be the vice versa because you're new to the market. So the property manager, he's going to interview you. It's not only one way, it's going to be two ways discussion. So how long did it take you to establish this relationship with your core team?
Yeah, and what we do is we, earlier in the last couple of years, I used to attend a lot of events virtually, and nowadays in person to network with a lot of other operators,
Okay.
and other operators that are already doing deals in this specific market,
Mm.
right? Or in these markets that I'm interested in,
Okay.
whether it be Dallas or Atlanta.
Mm.
And then you form a relationship with them, and if they've already done a deal, you can perhaps tag along with them,
Mm.
and then learn the process, and then you kind of leverage that to get to your next deal.
Okay.
You know
Yeah. Makes sense. Um, I think my next question will be about lending side. So you mentioned at the beginning that you were relying on debt partners, not equity partners. How does this change with the time right now? Are you still looking only for VTB or second mortgage or promissory notes, or it's now more about equity partners?
in the US or in Canada?
Both.
Both. Okay.
Because you
So
said that you
in
have
Canada,
already.
we yeah, in Canada, we are the we own 100% of all of our properties,
Okay.
because we did not have any equity partners.
Hmm.
But in the US, our model is completely different. We have all equity partners.
Okay.
Um, and the main reason is because we are able to offer them a much better return, and I feel comfortable about executing our business plan
Hmm.
because we're able to follow. There's no restrictions with landlord issues and rent control, so we can at least follow our business plan and move forward.
There's no
Implementing
speculation. You mean
yeah,
there's no
exactly.
speculation about the plan, which makes sense, of
100%.
course. Yeah.
100%. Yeah.
Yeah.
Whereas in Ontario, we didn't feel comfortable with that approach,
Hmm.
and so we didn't go with equity raise. We just did the debt way.
Oh, okay. Okay. My next question will be an actual deal structure part, which is I would like to highlight your largest deal and like more details about how you get the deal, purchase price, number of unit, your
Yeah.
renovation cost, and all of these details. I'm gonna ask you question by like multiple questions so we can understand how you managed. By the way, you closed the deal. I think we were talking about the Atlanta deal. It was a
Yep.
huge deal. I think 318 unit, correct?
328. Yeah.
28. I'm sorry.
Yeah.
So, what was the purchase price for the deal?
That one was 32 million.
32 million.
Yeah.
Okay. Number
We're
of unit.
currently now working on another deal, which is also in Atlanta, in a nicer suburb.
Okay.
And that one is 19 million.
Okay.
for 122 units.
Okay.
So yeah, it's we're really excited about that one that's coming through.
Which one you
And,
want to
and
start with? You want to start with the old one or the new one?
so maybe I can just describe a little bit about like, so what we're doing is in the US are what's called multifamily syndications, right?
Yes.
So you mentioned about the structuring part. It's an LPGP model, which is
Yeah.
LP meaning limited partners, where all the equity is raised through limited partners, and the general partners being the manager of the asset, the lead sponsors,
Yes.
right? And so yeah, this specific deal that we're working on is we're really excited about. It's took us a while to get to, there's a lot of bumps along the way to get this one through.
Mm.
We had some issues with the physical due diligence and trying to negotiate back and forth with the seller, but it's finally kind of coming through.
So you close on the deal or it's
No,
under
no, it's not closed yet.
under
We're gonna be
contract?
closing in a couple of months.
So it's under contract already.
Yeah,
You want to talk about this deal or you want to talk about the other one?
sure. Yeah,
Yeah.
either way.
We can start with the old one because I think you had already more solid information about it. So how long it take you to close the deal and who brought you the deal?
Who what? Sorry.
Who brought you the deal?
Yeah, it was through broker relationships,
Okay.
right? And there's only like in any given market, there's probably going to be like 5 brokers that deal primarily with commercial multifamily, right?
Yes.
And especially like 100 units
Above.
to and
Yeah.
above.
Hmm.
There's going to be some that are primarily like institutional level brokers, which they only deal with like maybe 300 plus units.
Which is REITs and trust
Yeah,
fund
and
managers.
primarily REITs are buying like Class A properties,
Yeah.
right? They're not interested in like the value add Class C properties.
Yeah.
So that's where any syndicator can come in and purchase those properties. So
Yeah.
you establish a good relationship with the brokers. Me personally, I flew down and met people face to face and build that relationship. And then you're you're gonna be getting deals in your inbox, and so depending on how many you can underwrite
Yeah.
that fits your sandbox, that's what you keep continue to do, right?
So what is the
And
best time to do the underwriting? After 10 a.m., 10 p.m. when all of the kids are sleeping?
yeah, I have another partner that does primarily the underwriting,
Okay.
um, that whom you met perhaps at the event. But yeah, so he does the underwriting, and if it meets within our investment criteria, like what I mentioned about cash on cash and the total return,
Yeah.
with a fairly conservative approach, right?
Yeah.
Where especially now with the way the debt markets are, we got to take that into consideration, where we're underwriting at like 5% plus cap interest rates,
Interest
and
rate. Yeah.
also lower loan to cost.
Hmm.
So we yeah, and then once that is done, then you book a flight to go see the property.
Okay.
Be in contact with the broker, and obviously then the next step would be to go tour the property.
So how long it take you to do the underwriting and how long it take you to for the conditional offer? It was for how long? 3, 4 weeks or for the
Yeah,
conditional offer?
it's not a directly an offer. It's we first submit a letter of intent,
Yeah.
um and then move forward based on that. So it's depends on if you're in competition or not. Then there's a best and final offer date.
Hmm. Correct.
But now things are kind of slowing down a little bit. Less offers these days than it used to be. It depends on the property and the area and all of that.
No, I'm talking about the Atlanta deal, the 328. How long
Yeah.
did it take you to close the deal?
Or
2 months?
closing in the US happens fairly quickly.
Okay.
Um, so we got this one that under contract in October
Okay.
of last year, and we closed
Yes.
in February of
Uh,
2022.
almost 3 months. Almost 3 months,
Yeah,
including
and
Christmas time.
it would have been actually a little bit faster, but we were delayed with some third party appraisers and
Oh, okay.
environmentals and all that. Yeah.
Okay. Okay. So what was the plan? It was like force appreciation, and how much was the renovation cost?
Yeah, so our plan on that specific property is to put in about $7,000 per unit in interior upgrades, renovate the
Okay.
units, right?
Okay.
Um, and we're bumping the rents from, let's say, on average 950 to around 1250.
Okay, it's a lot. It's three hundred
Um,
dollars more. Okay.
yeah.
Okay.
Um, and we're also doing some improvements to exterior, like seal and stripe the parking lots, add in more exterior lighting, um,
Landscape.
a little bit of landscaping, tree trimming, make it look a bit more presentable. Um, but for the most part, it was exterior wasn't was pretty well maintained.
Hmm.
There's some roof repairs to be done, so things like that. But primarily, our budget is going towards capex budget is going towards interior upgrades,
Okay.
and yeah, so we're just in the process of implementing that plan.
Okay. So what was the NOI before and after? Like before close, like on day one and after doing the renovation, the NOI.
You know why we analyze so many deals I don't know on top of my head.
Okay.
Yeah,
Yeah. Yeah. No worries.
yeah, it's just been
Long time.
quick. Yeah.
My next question will be how you made your deal investor friendly. How you and this one, I think you raised the equity partners with which is
Yes.
basically the LB part. So how you approach your investors and how you made that deal investor friendly. And you mentioned one of the issues which is I like, which is choosing a known market for our Canadian investors so they can make or understand where it is actually. I think it's easier to talk about Atlanta than when you're talking about Birmingham in Alabama.
Yes.
Yeah.
Exactly.
So, what was your approach to make that deal friendly?
Yeah. You know what? The biggest, I would say, the people want to see the returns, right?
Mm,
Obviously, once you have a relationship with the investor, the next thing is as the first step is obviously they have to know you, like you, and then trust you, right? Once
100%.
that is done, then the next step is what kind of returns are we looking at,
Mm,
and the returns are the cash flow and the equity growth is just can't beat what you're getting in the US.
mm,
So in terms of that perspective, it's kind of an easy sell to the investors.
mm.
However, I guess probably the number one question I get is about the tax implications, and
Yeah,
because it obviously there's extra layer of complexity because you're investing across a border, right?
yeah,
So yeah, I would say that uh, the because of the high returns, the high cash flow is probably the most attractive part, because some investors, they don't want to wait 5-6 years to get their returns.
mm.
They're looking to get some cash flow now, and with 7 to 8% cash flow, it's very attractive
100%.
because
Uh,
that they get that money in their account on a quarterly basis. You know.
yeah, yeah, yeah. So you're using every 3 months. Okay.
Yeah, we do a quarterly distribution with the cash flow.
So I think my next question will be um, how you structure the deal from the legal side of credited and accredited. Did you approve any non-accredited investor on your deals, especially on the last one, or all of them was accredited investors? especially to
Yeah,
meet with the US part, which is 506B and 506C when you're uh, presenting your deals.
yeah. So we did a 506B offering, which is basically, like you mentioned, SEC regulation.
Hmm.
And 506B allows you to work with non-accredited investors as
Hmm.
long as you have a personal relationship,
Yes.
whether they be friends, family, or business associates.
Yeah.
So that's the route we chose. Um, so they were a mixture of both.
Okay. Okay. Um, as next one was the structure, always as people think about when because in your case you're collecting, or you have the two sides. You have credit, you have US investor and foreign investors. How you dealt with the security part of having the two different loan structure from two different sides, because you're collecting money from or raising money from US partners and Canadian partners. I know before we jump into this, I think we're just saying that this is just a high level, and if anyone need to understand more, have to consult his security lawyer and accountant to get more information about this.
Yeah, for sure. I highly recommend people seek their legal and financial advice.
Yeah.
Um, and yeah, so we have for the American investors, it's a simple process because we it's a straightforward, right? They don't have to deal with any cross border stuff as long as the securities laws are met,
Yeah.
and that portion. And then from the Canadian side, it's the yeah we depending on where you're raising the money from, because the U.S. part is a federal thing. SEC covers entire USA,
Mm.
whereas um, with Canada, there is provincially regulated the securities laws, right? So there's an Ontario Securities Commission, British Columbia Securities Commission. So you have to deal with depending where your investor comes from.
Yeah.
Um, so yeah, for and we have to go through a securities lawyer here in order for to make sure we're compliant with raising money from Canadians.
So I think the actual advice here, when you're doing the similar deals, you have to have two different lawyers to comply with the two different
That's correct. Yes.
yeah, with the Ontario, for example, and whatever states you're investing in on US.
That's right. That's right.
My next one will be a little bit tricky because you're a Canadian investor where we are really famous with the 50-50 approach. But in US, it's more about 70-30, 80-20 maybe for profit split. So in your latest experience, how you approach this when you're dealing, because when you're dealing with US investor, they more familiar with the 70-30 approach. But
Yeah,
here in Canada, it's
and
50-50.
that's for I would say, like you mentioned, syndications are primarily multifamily syndications. To be
Yeah.
specific, they are there's a range, right? Of it could be 70-30 split, or 80-20 split, or anything in between.
Yeah.
Um, right. So we primarily do 70-30 split,
Mm.
of which 70% of the profit
Yeah.
sharing is goes to the investors.
Yeah. So your waterfall is always based on the profit only percentage wise, not an, I'm not going to say guarantee return because there's nothing guaranteed here. We're doing our best efforts, but it's based on the actual profit percentage, correct?
Yes.
Oh, okay. Okay.
Yeah, so
So,
there's a split among everything, right? Cash flow,
yeah,
um, and not to get too complicated, but there's also a preferred return
returns.
portion,
Yeah.
right? And then just to give you what that preferred return means is that, for example, on our deals, it's a usually an 8% preferred return. So that simply means that the first 8% return goes to the investors
The passive
before
investors first. Yeah.
yeah before it gets distributed to the GPs.
The GPs. Yeah, correct. I think you mentioned something. It's really scaring all of the passive investor to work on US, which is double taxations. So, what was your approach to show or present this solution to avoid double taxation for them?
Yeah. Main thing is to seek correct legal and cross-border advice.
Yes.
And so for example, if you are using, in common in the US is using an LLC,
Yes.
right? However, LLCs are not recognized by Canada, right?
Yes.
So you
The
cannot use
CRA,
that. You
the
cannot
CRA
use that structure.
didn't recognize the LLC.
Correct. So we use an LP structure,
Yeah.
right? And so we form the LP uh, for American LP on behalf of the Canadians that are investing, and it's kind of a fund to fund structure. So
And
we're
as you
raising
mentioned, you
money.
have to cross
Yeah,
check with a specialist on the cross border taxes to give you um, the actual advice based on your case. But 100% what you said is 100% correct.
yeah.
Yeah. So I think my next question will be about the inflation. It's a general question about the inflation. How the inflation affected your system for raising capital and choosing deals lately, unless especially starting from February?
Yeah, you know what? There's a lot of uncertainty in the markets right now, or
Mm,
in our economy, and so I tell our investors that, hey, look what's happening in the stock market. What kind of alternative investment vehicle do you really have,
mm,
right? Um, Especially in a high interest rate environment and a high inflation environment, you want to you want to you want to bet your money in a hedge against inflation type of investment, which, my opinion, real estate and specifically multifamily is the best spot. Because although everything else is changing in the world, you know uh, people always need a place to live,
mm,
and that's what we're providing them. We're providing people with workforce housing, so it's not a luxury apartments.
mm.
It's just basic, clean, nice, affordable apartments
Yes.
for people to live in. And with obviously still a huge shortage in the US, obviously in Canada a much bigger shortage, but there's roughly 1.5 million rental housing that's needed in the US that are that cannot be satisfied.
Yes.
So there's still pressure for the rentals, the rents to keep going up,
Yeah.
and that's what obviously we make sure our properties are well cared for, and they look much better than our competition, so that we get better rents, and our investors are happy as well.
100%. My next fun question will be based on 12 years experience. What will be your superpower? How you define your superpower?
Yeah, I would say my superpower is my partner, my partner in crime, my wife,
Mm,
Khadija. She's truly been a great support for me
mm.
in my journey, and she's an integral part of our business as well. So really, we work on our business together, and that's why we've kind of became a power couple and grew together. So uh, her support has been absolutely amazing.
I think this is a great question, as a great answer, and you're gonna have a great night today. She's gonna be like, she's gonna love this answer. So yeah, so my next question will be about mentorship and coaching. Who was your influential mentor on the last years, especially on the multifamily, as a role model and or in the business in general?
Yeah, I wouldn't say I have any specific ones, but I have read through a lot of books
Mm,
in the multifamily space. Uh, there's lots of great authors. For example, Joe Fairless,
mm.
specifically for the syndication,
Apartment
apartment
book.
syndication.
Yeah.
Yeah, there's multiple other ones like Michael Blanc,
Oh yeah.
um,
Yeah.
and
I think Michael is focused on Atlanta market, correct? Michael Blanca is in.
There's a few
He's
people at I mean, they're kind of diversified.
yeah.
But yeah, there's lots of resources. US is a huge multifamily market, so there's so many
Mm,
great podcasts
yeah.
and books out there, resources, coaching programs, um, that you could be part of. But ultimately, it comes down to taking action and figuring it out along the way, right?
Yes. Yes. Yeah.
And each deal, each one is getting a step closer to
Your goal.
um, our goal.
Yeah. Yeah. Thanks for so much for doing this to us. And my final question will be how people can follow your success.
Yeah, so we have a great podcast out as well. There's no number of ways you can reach us. So one is please listen to our podcast. It's called the Savvy Real Estate Investor Show,
Mm,
available on iTunes. You can reach me through Instagram, Jose Jaffarji, and yeah, or just go to our website, savvyrealestate.ca.
that's great. That's great.
And
Again,
yeah.
thank you a lot for coming to the show, and we'd love to bring your partners on next time. You have a great, powerful partner helping you on raising and scaling your portfolio, and we're really happy to bring you again to the show.
Yeah. Thanks for having me.
Thanks a lot.